Today we are talking about buying your first home. I'm here with Frank, a mortgage professional, and I am Robert, your moderator, just here talking, about to be a mortgage professional.
Yeah.
So Frank, I'll let you introduce yourself.
Hey guys, my name is Frank Kent. I'm with Franklin Mortgage. I'm the mortgage broker, mortgage lender, and the owner of the company since 2017. We've been originating loans. Currently we licensed in 5 states: Florida, California, Georgia, Tennessee, and Oklahoma. And I'm happy to be here, and hopefully we'll be helpful answering the questions you have already.
Absolutely. So the first question is, what is the first step a first-time home buyer should take when considering buying a home?
Oh, excellent question. I ask it all the time, but the answer should be, I think, multi-angle. And I always tell people that, try to look at yourself from a lens. Like, how do you look in the eyes of the banks? How well of a character you are that banks would consider lending you the money at the best possible terms. And when we evaluate the profile, we usually use 5 C's of the mortgage origination. There are character. We're going to talk more about it. Another one is capacity. Third one is the capital. Fourth one is the collateral. And the fifth one is the conditions. So if I shortly mention all of them, so character. The banks don't care about you as a character. It's not like, we want the guy with a good sense of humor or whatnot. No, it's not the character they're looking for. They're looking for a character to develop an understanding what kind of borrower you would be.
Yeah, that makes sense.
And to do that, they use 2 central sources of data. One is your credit report, and another one is the public records. Public records are usually nothing positive, meaning, it's judgments, divorces, whatever, lawsuits. That's not something people usually should be proud of, but putting that aside, the main thing is a credit report. And the character speaks for itself. Credit report is self-explanatory, meaning that how much you borrowed, how often do you borrow, how often do you repay, what balances you keep, and how often do you apply for the new credits. That tells banks a lot to know about what you've been in the past, so what kind of picture they would see with you in the future with paying a mortgage payment. Because at the end of the day, for them, it's a risk to reward game.
Yeah.
They want to understand that if you appear on paper as a well-qualified borrower, that reduces banks' risk on paper, and therefore you're going to be receiving the better rates, the higher leverage, and the best loan products.
Yeah, so you would say the first step that everyone should take in buying a home is to make sure that character on paper is up to par.
Oh yeah, credit worthiness is everything. I would always say 70% of our work is done not during the loan process, but way in advance of you applying.
Okay.
If there are credit imperfections, if there are undeveloped credit, listen, guys, it's not that hard to get it done. Starting with authorized credit card additions to your parents' or friends' credit cards, getting yourself a secured credit card, getting yourself I mention it all the time. There are third-party services that allow you to report your own rent, your own utilities.
Okay.
Have those services to report them to your credit bureau, so you do have a credit score. And that can be done within 6 to 12 months if planned strategically. And that's a good starting point.
Yeah. And the next question is, how important is pre-approval, and how does it impact the home buying process?
Okay. Pre-approval, I think I would say, is a key step to advance from point 0 to point we're moving forward. And during the pre-approval process, that's exactly where the following C's come in. We're going to look at the capacity, and we'll look at the C for capital. Capacity is your debt to income ratio. Like, how much can you really borrow, and how much of the house you can really afford.
Yeah.
So with that capacity, how do we evaluate it? Well, it's not a rocket science. It's relatively simple. We look at your credit report. we say, okay, Robert, you have $500 credit card. I'm sorry, $500 car loan. You have $300 in credit cards and $300 in student loan. So it's $1,100.
Yeah.
I'm gonna say, okay, we evaluate, do you have funds today to pay off any of these liabilities outside of down payment and closing costs? No, you don't. Meaning that we have to live with this $1,100 for our debt to income. Then you say, look, I make $10,000 a month, of which $5,000 is going to be a qualifying income for to cover all your debts.
And what's a normal debt to income ratio for most loans? Like where do you want to be, and where is acceptable?
Well, that's a good question as well. Where do you want to be? I think, in my opinion, 40 to 43% of all the debts to be, including your future mortgage, of your gross income, is considered healthy. Lower the better, of course. But when you look at the conventional loans, they want to see the back-end DTI not to exceed 50%. When we look at selective mortgage lenders, they do FHA loans. Some of them push the DTI on FHA loan to 55%. But as I said, jumbo loans, you once again going to be likely restricted. But healthy DTI, under 40, maximum DTI, about 50%.
Yeah, and we hear pre-qualified, pre-approved. What's the difference between the two? Because some people might be misled.
Okay. So let me make a silly analogy about it, I would say. So imagine you have a pain somewhere in the body, and then you went to local psychic and sit down and told her that what hurts. And she looks in the sky and says, well, it's nothing serious, Robert. In 2 weeks, you'll be fine.
Yeah.
Okay.
Sure.
And then opposite to that, you say, you know what, let me go to see a doctor. The doctor orders all the tests, all the, CAT scan, the ultrasound, and sits down with you in 2 weeks and says, look, Robert, this is what we've discovered, and this is how we're going to cure or treat it. So in the mortgage world, seeing a psychic is a pre-qualification. Pre-approval is when you've been diagnosed. So in other words, let's say, I interviewing you and you're saying, hey, I make $60,000 a year, I've been employed for 2 years, I have $30,000 saved up, and I want to buy a $300,000 home. Well, just as easy as you said it, as easy as I said, oh, great, you're pre-qualified.
Yeah, it sounds good on paper.
Yeah.
Sounds good.
I can even give you a paper. So I wouldn't, because I just, to me, I think it's a lazy work to even do this, but some maybe people in the industry can give you a pre-qualification letter saying, subject to the interview.
Yeah.
Interview.
But which one do you trust?
Oh, no. But the thing is, if you try to take that offer and you're represented by a seasoned realtor, as well as the seller who's represented by a seasoned realtor, or the seller is not a first-time home seller, they will look at it saying, well, pre-qualified, what does it really mean?
Yeah.
And then you yourself wouldn't be able to answer the answer is, I spoke to a mortgage guy. Yeah. Well, good for you.
So you most definitely want to make sure that you're pre-approved and not just putting all your eggs and trusting pre-quals.
Yeah, pre-qual is, I think, pre-approval is not an overkill.
Yeah.
Pre-approval, it's a realistic expectations based on your income, based on your liabilities, based on your expectations.
Yeah.
What can you buy? What can you afford? You can take it to a realtor, and it's pretty much, I would say, in many cases, 70 to 80% of the homework that we as a mortgage professional do to get you pre-approval.
Yeah.
And in fact, we run automated underwriting software. Most of conventional loans and FHA loan programs have it. So when we plug in all the data up front, it tells us, look, you are eligible the way it is, or the software says, this client is not necessarily eligible unless he brings a little bit more in reserves, unless he brings a little bit more down, unless his employment is a little bit better documented. So we kind of already know our
limitations per se.
Oh yeah. We already kind of developed this understanding to like, hey, listen, Robert, based on what you told me, based on the automated underwriting software, I can tell you that you're going to be well qualified.
Well, and what is worse than not getting the number that you wanted is getting pre-qualified for the number that you wanted, finding a house, and then trying to go through all the work and then not being able to hit it. So that sounds
It's disappointing. It's disappointing for all the parties.
Yeah. So one of the questions that we get a lot, and that I think is almost becoming a myth in our culture, is: do you need 20% down to buy a home?
That's for sure is the most common question I hear all the time, because we were raised in generation of our parents, and they used to go to their traditional banks on the street, and then that used to be the rule, 20% down. But we are certainly not living in an economy that our parents used to live in. The home prices are triple, tentuple in some areas versus where they used to be in the 80s. There is simply no way, realistically speaking, for majority of the first-time home buyers to save that 20%. Look, average home price is $360,000. 20% is $72,000. Closing costs another 3 to 5%. You can easily add another 15 on top, and here we go. Here we go. At $90,000, you need to close on an average home,
plus the rent that you have.
Oh yeah, I mean, exactly. So if you want to save $90,000, it's going to take you. I mean, if you're really aggressive and you say, you know what, I'm not going to eat. I'm going to work 24/7.
Ramen noodles.
Yeah, ramen noodles. I mean, you're going to say, okay, you can save $90,000. I'm assuming if you really get another job and just, what? But people, but let's be realistic. People have families, have kids, have expenses.
Well, I think another thing that people don't realize, it's like, well, sure, yeah, save that, but then you'll be spending all this money on rent. Then you'll be spending all this money on other expenses that come up. But the biggest thing is inflation and houses appreciate.
Oh, yeah.
So I know that you just recently made a short over this that should be posted.
Yeah.
It just breaks down the financial difference in between putting 3.5% down and putting 20% down. So
absolutely.
And if you guys go and watch that video, putting 3.5% down is exponentially better financially with the numbers that we ran over and over and over again.
No, and I think to conclude this thought, many of people out there are concerned about, oh, how about my $200 PMI? And I always tell, how about your $1,800 a month rent?
Yeah.
I mean, how about that? I mean, once again, remember, when you have an $1,800 mortgage payment, yes, in the beginning, majority of it is going towards interest, but there is a small portion that you're still putting towards the principal. And nobody's prohibiting you to put more towards the principal to repay this debt. While with the rent, you are always on that same point A. You will never progress to point B, except every year your landlord is going to be increasing your rent.
And you're not seeing appreciation value.
No, not at all, and not at all. And then just to conclude, to 20% thought, 3.5% is going to get you an FHA loan. 3% down payment is going to get you to first-time home buyer as a conventional loan. If you're buying a 2 to 4 unit properties, which some of you guys may consider, probably should expect 5% down payment on both FHA and conventional options. And obviously closing costs and some reserves needs to be accounted for as well.
Yeah, absolutely. So the next question is, how does my credit score impact the rate that I get?
Well, the credit score impact not just the rate. The credit score may impact whether you get the loan or not to start with.
Yes. Yeah.
I mean, if you for FHA loans, minimum credit score is 580, and I'm talking about automatically underwritten FHA loans. Of course, we can go to 500 to 579, which is a manually underwritten FHA loans. Yeah, I know it's scientific, but then it's going to be just, you have to meet so many additional conditions that sometimes it becomes like, why are we even doing it? But putting that aside, you don't get a 580 or above, you're not getting FHA loan. You don't get 620 or above, you're just not getting a conventional loan. And there are two major economic differences between having, let's say, 620 or 720. The same first-time homebuyer program, under that program, your rate may not be significantly higher, maybe 1% between them two, but your PMI with 720, the same loan amount could be $120, $150, and with a bad credit, it could be $250. So it's a double punishment. You're getting punished on the rate, and you get punished on PMI. So think about it, $200 here, $200 there, and here it is. Same loan, meaning the same loan amount that could have cost you monthly $400 less, is you're going to have to pay $400 just to just to prove the world that you're not as bad. I mean, I'm like, hold on a second. That's why we talk about homework, getting the credit up, up as much as we can, and there are tools for it.
So if someone is in that 500-600 range, if they're not where they want to be, what are some steps that they can do within the next 30 days? Maybe just a couple steps they can do in the next 30 days to bring that number up, and that could possibly save them literally $100 a month.
Yeah. So this is how we look at it. From experience, if the person is in the 500 area, that's certainly some derogatory items in the credit. It's either collection, late payments, maybe some judgments or whatnot, because that's what really brings the credit so low. In 600 category, I'm assuming it could be a high debt to income already, meaning that the credit cards are full, the balances are very high. So depending where we are, let's say if we are in the 600 range and we just have a high balances, but we've been responsibly paying them, which is, believe me or not, is better than not paying, of course, then we need to, this is how I do it all the time. I do an Excel sheet, I love Excel.
Yeah.
I put the balances next to each other and I put monthly payments. Then I divide the monthly payment to the balance so I know what portion of principal balance is going to cost me a month. And I start tackling basically the ones that are costing me the most amount of money. Meaning that, let's say if a balance is 5,000 and the payment is 500, I mean, and the payment, I don't know, includes a ton of interest, and I would think that this is going to be the first one I need to kill.
Yeah.
And then let's say if there was a balance of 15,000 a car, and it's only a loan payment, and it's only a balance of 400 a month, then I'm going to say, you know what, it's not my priority right now, because there is not much I can do with a trade line. I'd better dedicate my resources to tackle down the balances that are costing me the most amount of money on interest.
And that's called the avalanche method.
Correct. So no matter how you guys look at it, getting rid of the debt is an ideal.
Yeah.
But getting rid of the highest interest rate debt is practical.
Yeah, absolutely.
So, I mean, that's one thing you can do. For $500, there are some secrets here, right? Unless you have a crazy large collection, which probably a medical bill. But to be honest with you, listen, collectors, and we talked about it, when creditors or collectors, when you stop paying them in their books, it's already almost a write-off. So any money they can collect is a profit.
Yeah.
Or revenue, whatever the case is. So you just have to be strategic about it. Negotiate. If you have a little bit of time, nothing is rushing you, make some phone calls saying, no, that's too high, I'll have to call you back. They'll come back to you with a better offer.
Yeah.
If you don't have the time and you have to settle ASAP because you are in the middle of mortgage process, of course, then it's going to be a little bit more expensive.
Yeah, so you'd say the first step is to call, make sure nothing's in collection. If there's stuff in collection, try to pay it off, negotiate your best, and get that off, and get your letter, and get your credit score higher. And then the second thing to do is just make sure that you're making your payments. Start attacking your debt.
So I would say that if there are derogatory items, lates and stuff like that, they are the biggest killers. They do 70 to 100, 150 points off of your score.
Yeah.
So if my goal was to get to the best possible score ASAP, I would have to start dealing with those issues first.
Yeah.
And then I would start, in the same time, concurrently, try to reduce the credit card balance to less than 30% of their limits.
Yeah.
And that would be my strategy.
Yeah, that makes sense. So the next question is different loan types. What are they? What are the 2 or 3 biggest loan types, and what are the pros and cons?
So for the first time home buyers, obviously we recommend, and most commonly we use FHA loans and we use conventional loans. The pros of FHA loan, they're more flexible when it comes to imperfections. Imperfection in credit, imperfection in length of employment, imperfection on maybe certain gaps in employment. FHA is better. Also, with some lenders, we can push FHA loan to up to 55% debt to income ratio.
Oh, wow.
Which sometimes helps when the income is just not, it's just not covering the debt as we wish. And the only obviously negative side of it is mortgage insurance on FHA loans is slightly higher than conventional loans. And whether you pay off your FHA loan to below 80% loan to value or not, that mortgage insurance will stay with that loan forever, unless you obviously at that point simply go and refinance into a conventional loan and get rid of that PMI. Versus with conventional loan, it's like a step-by-step plan, right? You got the conventional loan and that PMI, with every mortgage statement, you're gonna be looking, damn, I'm paying $200 for insurance. And guess what? That insurance doesn't cover you. That insurance covers your bank in case something goes south with you. So it's like, okay, I'm paying my bank's insurance to protect them against my default. It's like, okay, kind of doesn't make sense because you're confident about your abilities, your bank doesn't. And you're like, damn, I can't wait to get rid of this PMI. Yeah, if you can't wait, there's nothing is prohibiting you just to making additional principal payment, getting to that point as soon as possible. Meanwhile, the property value probably appreciates. Then you're going to submit for new appraisal or loan recasting, and at 80% loan to value, you can get rid of the PMI. So these are some pros and cons. In addition, now lots of guys are asking, hey, how about if I'm self-employed? How about if I have a irregular income? How about if I have a seasonal income? How about if I'm have a diverse income, like I don't know, dividends? The interest income, real estate income, business income, this and that. I'm like, okay. So for that, for those purposes, Market has a product called non-QM loans, which is conventional loans. They come with 30-year, 15, 30-year terms. Okay. The rates are very close to conventional, but the guidelines are significantly different because they're common sense loans.
Yeah.
They're designed for self-employed business owners and so on and so forth. But if conventional or FHA loans, you can get in with 5%. For those loans, you generally expect 10, 15 to 20% down as a starting level, depending on your credit.
Yeah, that absolutely makes sense. And I know you've touched on this already, but how much should a first-time home buyer save up? And is there zero down payment assistance? You hear about that sometimes. What does that look like? Because I know you don't necessarily get something with nothing.
Okay, so the question was how much total people need to expect. So putting aside the DPA, which is down payment assistance, just for 1 second, let's say you're trying to buy with FHA loan, 3.5% down payment is pretty much, has to come from you. It can come from a gift funds, so we can cover that, but in addition to that, there's going to be closing costs, which depending on the state, depending on the local governmental fees, etc., it's probably going to be 3 to 5% of the purchase price you have to expect in the closing costs and borrowing costs, such as lender fees, underwriter fee, so on and so forth. And what I always recommend is, let's say you got your first home. You moved in, and here it comes. Oh, the carpet is not new. Yeah. The paint needs to be refreshed. Kitchen appliances need to be thrown away. All of that is some, if you're not the first-time home buyer, but you're a seasoned home buyer, that those are going to be whether you want it or not, the house is not going to be, unless it's a new home, the house is not going to be perfect.
Yeah.
So and then I would say you're going to have that money in the reserves. First of all, the reserves, you can't come out of closing with $0 in your pocket because it's just risky for you. What if? There is what if. And I would say purchase price, down payment, whatever the down payment is, closing costs 3 to 6% to be healthy, and then another 5% of the purchase price, if possible, to be left in your account so you have several months of mortgage payments. You have your basic cosmetic, the budget for basic cosmetic work just to get the house to your level.
Well, I know my wife wouldn't like sitting on lawn chairs, but I know I'd be okay with it.
Well,
so you're saying about 10% overall of the purchase price just to be comfy, maybe 12, maybe you could get by with 8, but probably 10% to be in a decent spot if you're putting 3.5% down or 3% down.
Yeah, that's fine. And then speaking of the DPA, which is the down payment assistance programs, 0% down and so on and so forth. Yeah, you guys have been hearing it all the time. There is a fine print. There is a fine print, and it certainly is screaming at you. 0%, I can go in, and there are lots of fine prints. So first of all, you have to check with your state, with your lender. Are you even eligible for this program? Some of these programs are designed for lower income bracket. Some of these programs only work in certain zip codes. Some of these programs are designed as a grant, which is ideal, but some of them are designed as a piggyback mortgage, meaning that it's like a second mortgage to cover that gap. And don't get me wrong, guys. So for example, let's say there was an FHA loan, right? It's a 3.5% down. Let's say your rate would have been 6.5%. You would say, okay, but then you don't have that 3.5%. So the lender, these guys come up being creative. They say, oh, you know what? We're going to give you that 3.5% of the second mortgage, which is like great. And we charge you nothing for it, zero interest, and 0 payments required. So that's done strategically, so it doesn't affect the DTI.
Yeah.
But that 6.5% rate all of a sudden becomes 7.5% rate. So technically, you're paying 1% extra interest on 97% of your loan just to cover so-called interest-free 3.5%.
Yeah.
I mean, guys.
They're getting their money either way.
Yeah, they're going to get money. So, I mean.
It makes sense sometimes.
No, it does make sense, especially if you intend to. Well, the problem is, whether you intend or not, you already agreed upon to the higher interest rate on the first. So it's not that you can pay it off, good for you, but at this point it's interest-free and doesn't require payment, so I don't think it makes sense. But they will get paid off when you want to refinance. And that's, that's one thing. But for example, in Florida, we have a Hometown Hero program, which is one of our biggest wholesale partners. UWM offers it. The issue with that program is that it comes out, a month later, weeks later, that's it, it depletes. So there is never money into it, meaning that they accept all of this flow of applications, give away the money, and then the thing is, the moment the rate is locked, they have to allocate this money from that program because supposedly the lock of the rate almost like a close of the loan. So, and then basically we can never say, hey, Robert, I can approve you for that program.
Yeah.
But I can never be 100% sure that by the time you get your home under contract, by the time you're ready to go, everything is lined up, that program still exists. So I would say that strategically, count as if you're doing a loan without any of those special programs. And if your mortgage professional can introduce you and offer you that, guess what? Win-win.
Yeah. Or even ask about it.
Yeah. I mean, and if it's not really possible at that time, at least you did have a plan A to start with.
Yeah.
And that was the plan B, or whichever plans B or A was. But but you did have it, because otherwise, imagine we qualified you based on that program availability.
Yeah.
You got it on the contract. The program ran out of money. So what happened now? Where are we at?
Yeah.
I mean, so we want to avoid all of that.
So the final question, in one sentence, what is a pro tip you would give first-time home buyers? And in one sentence, what is a pitfall or a pro tip? Final question. So in one sentence, what is a pro tip that you would give first-time home buyers that is a must do? And what is a pro tip that you'd give first-time home buyers of things to avoid?
Oh, great. So the pro tip is, I think, is to look at the process of home buying as if you're running a marathon. You can't really wake up one day and say, I want to run 26 miles, without conditioning, preparation. It takes a little bit of time. Yes, that time can be shortened and streamlined with professionals on your team, but still, if you made that decision to buy a home in 3, 6, 12 months, whatever that might be, And whether it's one of those 5 C's, going back, capital, character, capacity, any one of those, you need to start working on it today, and you need to be strategic. And the best way is a good old-fashioned checklist, as if like, hey, credit, what do I need to do? Down payment, where do I stand? You know, my income, you know, can I improve? Can I take an additional assignments, or should I report an additional income somewhere? Find it.
Yeah.
So that's my advice. You know, yes, you can say that, oh, my mortgage guy, he can get it done for me. But hold on a second. How about what can you do for yourself first?
Yeah.
Ask yourself that question and make my job easier, and I'm going to make your process easier. It's actually win-win for both sides. So I would say that realistically, it's just to get a plan. If you need a plan with helping with developing a plan, reach to your real estate professional, reach your mortgage professional, and
or
then
him.
Yeah. So you know that's what I do all the time.
Yeah.
Because in average, my average client, from the initial conversation to closing, it's 2 to 3 months in many cases, because people just, it's not that easy just to get approved, find a house, buy a house. It just doesn't work this way.
Yeah.
So that's about it. Regarding the pitfalls and all that is just, in my opinion, what I've been seeing a lot recently, it's expectations. It's, which also kind of relates to the first thing, but I'm seeing it quite often that when my initial interviews, about 50 to 60% of interviews, when the person speaks to me, the expectations are way out there. And I always have to tell people, look, hold on a second, the income is not there, the liabilities are not there, credit score is not there. So, and to make that work, I think that the best way is the transparency between yourself, your spouse,
Yeah.
and then your mortgage people, just to be transparent. Like, you see, don't expect that. You know what? Let me stay quiet about certain imperfections that I know of, and see if they're going to find out later or not. Mention from day one, because the issue is not you. The issue is there are over 20 to 30 loan programs that many of you guys haven't heard of. We in the business know and work with them all the time. So if I don't know the full scoop of what's happening, I will be under impression that, okay, maybe I'm going to use this program that I thought is going to fit you the best, but then those details that you forgot to disclose come up,
Yeah.
and we're all back to nowhere.
Yeah, so you'd say the biggest pitfall to avoid is to not disclose all information to your
Yeah.
lender, and to have the correct expectations.
Correct expectations,
Yeah.
and yeah.
I think that's huge. Well, thank you, Frank, and thank you, guys, for being here. And make sure you drop your comments down below if you guys have any questions or topics that you want us to cover in the future. Thank you, guys.
Thank you, guys.